Okay, welcome back. We're going to talk about supply and demand in this unit. I hope that this isn't boring. I was wondering when I started thinking about supply and demand if it would be boring. So we've done a couple examples toward the end, one that has to do with financial markets and the other that has to do with macroeconomic stuff that we've actually touched on before. So I hope it's interesting. So the objectives here, what's a market definition of supply? A similar thing for demand, a similar thing for equilibrium. Understand and explain the financial markets application, and understand and explain the Keynesian style labor market explanation. So let's set the stage for what we mean by a market. I'm going to restrict the world in a certain way. So let's think of it as a market for the moment for oranges in Southern California. And it has this structure. First, there are a lot of suppliers. Not any one of the suppliers is large enough to impact the market. Then there are a lot of buyers. Again, none of these buyers is large enough to impact this market. Also, there is essentially no or very little government intervention into this market. This has a name in economics. It's called perfect competition. It's not particularly important for this unit, though. Okay, let's talk about supply. Suppliers in this market will supply more if the price is higher, right? So growers of oranges, if the prices of oranges were higher, it pencils out for them to plant more trees and supply more oranges to this market. They also can supply more to the market, or would be willing to, I should say, if their ability to bring that supply increases, i.e. through productive capacity or technological innovation. They would supply less to the market, though, if their cost structure were higher. It's because things don't pencil out to supply as much, right, if their cost structure is higher. Okay, these characteristics imply that we'll have a gently upward sloping, positively sloped supply curve. And we'll get to the graphs in a minute. Now, demand, we have some sort of similar kinds of characteristics on the demand side. Buyers buy less if the market price rises, right? The goods or services they're buying, or the oranges, are more expensive, so they'll buy less. They'll buy more if their wealth increases. They'll buy more if their current income increases. They'll buy less if the cost of a complement rises, right? Because they consume oranges with a complement. I don't know what that would be. Peanut butter, I guess. Maybe not. Anyway, if the price of a complement rises, so they pull back on consumption of the complement, they would pull back on the consumption of oranges as well. And they buy more if the cost of a substitute rises, because then they would just switch out of oranges into the substitute. These characteristics imply there's a typographical error here, a downward sloping demand curve. Okay. All right, so what is equilibrium? It's where supply equals demand. Everybody's probably heard this, but that's not all. Just a little added thing here that's intuitive, I think. There's a price in the market that's consistent with the quantity being supplied as well as the quantity being demanded. So those things help us draw a chart like this. Probably everybody's seen this chart. I've got oranges there on the vertical axis, the prices, on the horizontal axis, the quantity. I've got a supply curve, upward sloping like we said. I've got a demand curve. After I fixed it, we said it was downward sloping. We put, for the P, for the horizontal line there, over to P star. It's common in economics to put a star where it's the equilibrium, and then also from where the lines cross down to Q star, again, it's common notation to use a star for equilibrium, and some little blurbs there about the P star being the price where the demand equals supply, and the Q star being where the amount being demanded is equal to the amount being supplied. Okay, we can have, excuse me, disequilibrium. There's two kinds. The first that I'll talk about is the excess supply. So this is a case where, for some reason, and there can be different reasons for this, the prevailing price in the market is higher than the equilibrium price, which is where the lines would cross. So you can see I've drawn a PES, I'm calling it, that's higher. So a high price is great for suppliers, right? They're happy to bring a large quantity, QS on the chart, to market if the price is high. A high price is bad for buyers. It becomes too expensive for some buyers. And so the demand at that price, PES, is very low at QD. So this creates what we call an excess supply condition if for some reason the price cannot fall down to where the blue supply curve and the blue demand curve intersect. The opposite case is where, for some reason, the price is lower than the equilibrium price where the curves intersect. So this is excess demand. So a low price means that those folks buying these oranges or whatever market we're talking about, they're happy to buy a whole bunch of it because it's relatively inexpensive. Suppliers are saying, no, 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 we can't break even at such a low price. We're not going to supply very much. So the supply, the amount that they're willing to supply is quite low at QS, and so we have an excess demand situation because QD is larger than QS. All right, so having set the stage for supply and demand, let's talk about some examples. Again, hopefully I can make this somewhat interesting through these examples. So this example actually starts with monetary policy. So the U.S. Monetary Authority, the Federal Reserve, or short Fed, has multiple policy tools available to attempt to influence the economy. They typically are attempting to stimulate the economy, although the other case in monetary policy is they're trying to tame inflation. I'm not going to talk about that one here, but here I'm going to talk about one of those tools, which is called quantitative easing. I'm going to use QE for short for that. It's a case where the Fed goes out and purchases bonds, like the 30-year fixed mortgage rate. Now, what's been going on in the past few years, the Fed has been mostly going into two types of bond markets. One is the secondary mortgage market. The other is the market for 10-year treasuries. So I've picked one of those as the example here. So what we're going to do is analyze this activity. We'll start on the next slide. So a couple of quick reminders that are probably known very well by everyone in this class. Most of what happens in bond markets is actually driven by secondary market activity, right, which is the buying and selling after issuance. Okay, so the QE impact on the mortgage market. So ignore the green lines for the moment. Suppose we started off in an equilibrium where the blue lines intersect, and so that's where P1 and Q1 are the relevant prices and quantities for bonds. So this is supply and demand for all those mortgage bonds out there being traded on the secondary market. There's a price on the vertical axis. It's the price of bonds in this case. Quantity on the horizontal axis. Pretty conventional. It's just for bonds, not oranges. So then the Fed steps in and purchases these bonds, some of these bonds. If they do it in a big enough way, we would see the demand schedule or the demand curve shift from D1 over to D2. That's the new green demand curve. And as a result, we would see the prices change to P2 and the quantity change, but I didn't label it. I'm going to focus on the change in price. That's what's most interesting to me for what I want to explain here. So I can see that from the chart that price would rise from P1 to P2. Okay, let's talk about that. So we've got that. Question now, what happens to mortgage rates? The previous chart does not have mortgage rates on either axis. We have prices on the vertical axis, quantity on the horizontal axis. No rates, no current yield on mortgage securities, right, in the secondary market. Well, what might happen to them is actually an important part of this story, and it's why the Fed would do QE. So let's talk about this. Don't use the graph, like I just pointed out. The rates aren't on the graph. Let's use finance theory. All of you are familiar with this. The theoretical price of a bond is the sum of all of its future cash flows properly discounted. And we have a lot of fun trying to figure out how to properly discount them. But that keeps us in business, doesn't it? All right. We know from that bond prices and the rates or the yields move in opposite directions. Okay. What did we show on the prior slide? I'm going to flip back. The prices rise. What do we know? We know that prices and yields move in opposite directions. That means that yields will fall. Mortgage rates will fall. Stimulating the economy. Why? Because buying a home, everything else being the same with lower rates, is more affordable. Okay, second example. So I hope that was fun. I hope this one's fun too. This is a Keynesian labor market example, and this actually ties conceptually to a comment I made in the business cycles unit. Keynes argued that macroeconomic labor markets, i.e. national labor markets, so don't think of a labor market, like related to a particular product or something. Think national, the entire country, okay? He said these labor markets have sticky wages. Let's talk about that. What the heck is he talking about? It's a situation where demand or supply might change, but wages won't fall. Okay, why might that be? Well, he said it's difficult to renegotiate labor contracts with lower wages. Very intuitive. Can you imagine being a business owner and going to your employees and saying, okay, everybody's wages are going to fall by 20%. Good luck with that one. So, okay, what impact does this have on national labor markets? Okay, got a chart here that has just a few things going on. So let's go through it nice and slow or whatever and try to make it clear. I spent some time with the colors trying to make it clear. We're starting off with the blue curves, the blue supply curve and the blue D1 curve. That's our initial equilibrium. So there's a Q star that is at the bottom of that intersection. That's my initial equilibrium quantity of labor. And then if I go from the intersection of the blue lines over horizontally to the left there, you can see a box that has a couple things in it, but on the right side is W star. Now, I've labeled the vertical axis here as W. Why? I didn't label it as a price, but it turns out wages are the price of labor. Okay, so that's that. So it's W, not P. And now, what can happen in a serious recession is total economic activity contracts. That's easy. All right. Well, if that happens, then all the companies out there that hire people, those are the folks that demand labor services. They're going to demand less labor services, right? They don't need as many workers. So that means the D curve here is going to shift to the left. And I've drawn, to try to make the graph clearer, I've made it shift to the left pretty far. And if you think about a serious recession like the Great Depression or the Great Recession, this is a good thing, this is a good way to show it. It moved way back because those were serious economic contractions. Okay, so if shifts way back to D2, which is in red, I've got the red arrows there showing that's where we're going. Now, if classical economic theory was correct and wages were flexible, wages just one example of a price, they said all prices are flexible, then there would be a new equilibrium at wage W flex there that's in black. But if Keynes is right and the wages are sticky and can't move, then the wages stay at W star. So I'm calling it also WES. Talk about the ES in a second. If the wages stay high like that, that means hiring labor services, is expensive. The firms that are hiring those workers don't want to hire very many at such a high wage rate. So the QD, which is their desired, the number of workers that they desire to hire is going to be low because the wage rate is high. These workers are expensive. At that high wage rate, the WES or the W star, those folks supplying the labor, i.e. the households in the country, they're happy to work at that nice, high, juicy wage rate, right? This is good stuff. It's good return on your time to working. So they are sitting out at Q star, right? So there's a lot of desire to supply labor on the part of households. Firms are saying, no, 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 it's too expensive for us. We're only going to hire at QD. This is an excess supply of labor. The amount of excess supply of labor could be measured. If you knew where Q star and QD were, you would just take the difference, and that is the amount of excess supply of labor. Well, that's just unemployment, isn't it? An excess supply of labor is unemployment. So why is this important? Keynes lived through the 30s, right? And in late 1929, in both the United States and in the United Kingdom, he was from the United Kingdom, there was a severe stock market crash in October. It led to a serious recession, as we all know. We've talked about that. Economic activity contracted severely. So he said, I can propose a theory through modifying the labor market with the sticky wage component that actually explains the fact that for years now, 1929, 1930, 1931, 1932, all through that period of time, unemployment was large and persistent. And that was important because classical economic theory until then didn't have a way to explain this phenomena that everyone saw occurring in the Great Depression. So this modification provides a way to rationalize theory with what was happening in the world. So those are the examples. I hope they were interesting. A caveat here, just a note that I won't be able to take time to go into. If you have a situation that's dramatically different from how I set things up at the beginning, in other words, if you have just a few buyers and or a buyer in your market, whatever the market is, that's incredibly large relative to the other buyers, that can change things. The same can happen on the supply side. So if you have just a few suppliers, or if you have one supplier that's really, really large and all the other suppliers are small, then that can change the analysis and make it a little bit more complicated. Those are called market power in economics. An example that probably everyone knows about is monopoly, right? If you have a monopoly on the demand side, that's a single seller. Whereas on the supply side, if there's a monopoly, then the way the curves shift and excess supply and demand can sometimes change from the kinds of things that I just discussed. That's it for this unit.